Hello everyone, welcome back to CFA with Jay. And today we'll be completing reading number 85, Portfolio Management and Overview. Okay, so first we'll understand what portfolio perspective is. Portfolio perspective refers to judging an investment based on its impact on the entire portfolio's risk and return rather than judging them individually in an isolation. Second is what is modern portfolio theory. So in this theory, which was introduced in 1950s, it states that unless the stocks are positively correlated, strongly positively correlated, they can be put together in a portfolio, which would help in diversification. So next is diversification ratio. Diversification ratio is portfolio risk divided by individual asset risk. Individual asset risk. So, lower the diversification ratio, better it is. Because, for example, now if you see, it is 18 is to 25 and it is given as 0.725. So it is quite lower, means your diversification is way better. If it was closer or a higher number, then that means that your portfolio's total risk is somewhere near to that individual asset that we are dividing the portfolio's risk with, that it is somewhere near to that asset. So, which does not give us a very good view on diversification, because we do diversification to reduce risk. And even after diversification, if the portfolio's risk is somewhere closer to asset and individual assets risk, then diversification is for sure not working. That's all. Next, we have to describe the steps in portfolio management process. So, first step is planning step. Now, what does this planning step mean? A customer comes to you, and when he comes to you, first you need to sit down and get acquainted with all of his things that really matter when you are making his portfolio. For example, the risk that he can take, the family background, what insurance he has, the suppose real estate, what real estate he has, what loan he has, then all other consideration which might have a direct or indirect effect on your portfolio performance or in their life. You need to know that. So in this planning step, you discuss everything. Now there is something called as IPS. So IPS means investment policy statement. In this statements, details about the investor's objective and his constraints are given. IPS should also include the benchmark to which the portfolio is going to be set. So now in this step, it involves analyzing the risk and return, and depending on the risk and return, they need to determine where to put how much. Means how much weightage should be given to a specific asset class and to a specific asset type. So one of the thing that is there here is a top-down approach. So in this approach, you start with a bigger picture. For example, economy, then for example, budget, then the budget where it is allocated the most, then that sector, then that specific sector's stocks which you want to invest in. So that is top-down approach. So sometimes some firms do take top-down approach. So once a specific asset class is decided, means suppose 25% to real estate, 25% to equity, 50% remaining to fixed income or okay. So once the okay. Once the asset classes are decided on how much to invest in which asset class depending upon the risk level. For example, if the investor has a very high risk tolerance, then most of his amount might go in futures and options, etc., etc. So depending upon his risk and returns tolerance, he needs the specific asset class need to be selected. Once they are done, then they go down to what type of asset to select in that specific asset class, and how much of that asset needs to be allocated to that money that which has been allocated to that class. So the next step is the final step, and it is called as feedback. So in this feedback, so over time, situations obviously change. Uh, the situation of the investor, his ability to take risk might change. The asset prices will change. So depending upon various asset prices, the weightage will change. So a person needs to rebalance. That's when rebalancing comes into play. So over a period, the person needs to keep rebalancing the portfolio depending upon the various changed needs of the investor. So in this step, the manager should also measure the performance of the portfolio relative to the performance of the benchmark that was stated in the IPS, that is in the first step, the planning state. So next we have different types of investors and their different characteristics. Very easy this is, but you need to keep this in mind. This entire chart should be framed in your mind. In first is individuals. So individuals like retail investors like you and me. That's what this individual means. Risk tolerance depends upon the person to person. If you're wealthy and if you want to take more risk, then fine. Otherwise, less risk. Then investment horizon, that also depends upon the individual. If I want to keep short-term investments, then I'll opt for 1 or 2 years. If I want long-term investments, then 10 or 12 years. Then liquidity needs, if I am opting for short-term investment horizon, then yes, my liquidity needs are high. That's why. So it depends entirely upon the individual and income needs. If my income needs are more, then I would rather choose the short term investments, right? Then next is bank. So banks, as we all know, are financial institutions which give out loan and earn income in form of interests and other ways. So what is their risk tolerance? It is very low, not very low, but low. Then investment horizon is short, liquidity needs is high. Now, why is liquidity needs high? Because anytime a customer can come to them and ask them for their money in return, so they need to keep certain amount of cash in with them. Hence, their liquidity needs are very high. What is an endowment fund? Endowment fund is a fund that is kept to fund the ongoing process or ongoing activity, we can say. For example, universities keep an endowment fund with them to fund their programs continuously. So risk tolerance is very high. Then investment horizon is long. Liquidity needs are low. As I said, if your investment horizons are high, then your liquidity needs are automatically going to go low. Then next is insurance. As we all know, there are different kinds of insurance companies in the market, and it is a place where if any unforeseen activity occurs, then the insurance firms or insurance institutions pay you a compensation or the claims that you need after the impact of that activity. So in this, their risk tolerance is low. For life insurance, the investment horizon is quite high because a life insurance, well, anything to happen to someone is very rare. thing to happen. And for PNC, PNC means property and casualty. So in property and casualty, the investment horizon is quite short, because anything to happen for a property, any casualty to happen to a property is quite more frequent. It might happen frequently than for life insurance. Hence, the investment horizon is high. Liquidity needs are lower for them. Mutual funds. Mutual funds, as we all know, are a group of funds where the fund manager invests in different types of assets. Then it depends upon risk tolerance, depends upon the fund. Obviously, if it is a high risk fund, then the risk tolerance will be higher, and if it is a low risk mutual fund, then the risk tolerance will be lower. Then same like individual, it depends upon the fund. If the investment horizon also depends upon the firm. Then liquidity needs, yes, they are high, because the mutual funds, we can sell and buy them anytime, so they need to have liquidity with them. Then defined benefit pension, we'll read about them here. So there are two types. Okay, so what is defined contribution pension plan? In this plan, the contribution, the amount of contribution is fixed, and the employee is the one who bears all of the risk. Employee is the one who chooses the amount, where the amount of that fund is invested in, for example, mutual funds. One of the example is the company in which the employee is working in contributes 10,000 rupees per month to that fund. So after 30 years, for example, how much ever you get, it depends upon the investment risk that you take and the returns that you get. That's the amount you will get at the end of the 30 years. What is defined benefit pension plan? So in this, your employer is the one who takes the full responsibility of the payment. For example, after your retirement, after a certain amount of years, when you retire, you get suppose 10,000 rupees per month. You'll get it continuously after the retirement. The investments decisions that are made for this fund is usually taken by fund manager or the employee. And regardless of how the market works, the employee is going to get certain amount, that the retired employee is going to get certain amount. Suppose, for example, as we said, 10,000 rupees per month, that is fixed. So therefore, defined benefit pension plan, this tolerance is very high. Investment horizon is long. Liquidity needs are low. Okay. So different aspects of asset management industry. So what is asset management industry? This industry comprises of different firms that manage the money of different clients. We can say this industry is divided into two different parts, that is buy side and sell side. So what is buy side? Buy side helps the firms, helps the clients to buy different products, for example, mutual funds. And the sell side helps to sell them, for example, Zerodha or broker, any broker we can say. Then there is full service asset manager. These are the asset managers that offer a variety of investment styles and across different asset class we can say. And specialist asset managers, these are the asset managers which manage a specific type of asset class only and have a specific investment style only. Then a multi-boutique firm, we can say it is a company that includes different kinds of specialist asset managers. So a firm where different specialist asset managers are there, and they uh, handle different asset class as per their specialty. Then we have learned active management and passive management before too, and also smart beta. It is the same as beta. Then there is traditional asset managers. Traditional asset managers focus on equities and fixed incomes, securities. Okay, next we have traditional asset managers who basically focus on equities and fixed income uh, assets or securities, for example, FDs. And then there are alternative asset managers which focus on different kind of alternative assets, for example, real estate, for example, hedge funds, etc. Then there is robo-advisors. Robo-advisors are the technology that is being used with the help of computer algorithm, which suggests you stocks or gives you investment advice. Then mutual funds and comparison of them with other pooled investments. So mutual funds, as we all know, are one of the form of pooled investments, we can say, where the fund manager takes money from the investors and invests it into certain different types of assets. Net asset value of each share. So, what is net asset value of each share? So, it is basically total net value of asset which is divided by the number of shares of that particular asset. Open end fund is a type of mutual funds where you can buy or sell the shares at any time you want. There is no restriction on the time horizon of the shares that shares that time horizon for the shares that you have been invested for. We go to next, that is close end funds. What is close end funds? These are the mutual funds which manages the money of the investors, and they do not take any kind of new investment after a certain period of time. They are specifically for a certain time horizon, so you cannot have an exit in between because it's a close-ended fund, as the name suggests. So while they are managing your money by investing in different pool of assets, yes, there will be fees. So what is no load fund? So no load fund means they do not charge any additional fees for purchasing or for redemption of the shares, and load fees charge either the upfront fees or redemption fees or both. Upfront fees means fees that are uh, charged when you are purchasing new shares. Types of mutual funds, money market funds. So, for example, if a mutual fund is 100% mutual fund. Okay, so in money market mutual fund, more amount of money will be invested in money market than in other asset classes, we can say. So, for example, 51%, we can say 51% of the entire money will be invested in short-term securities, and which will provide you fixed income. Then next is bond mutual funds. Bond mutual funds, these are the mutual funds which are specifically made to invest into bonds. So you get fixed income from these securities. Obviously, they are differentiated by bond maturities, credit rating, issuers, and types. Different types include government bond funds, then tax exempt bond funds, then high yield, etc. It depends upon your risk tolerance and the return that you want. You need to choose what type of bond mutual fund you want to invest in. Then there are different types of stock mutual funds. So, what are stock mutual funds? Okay, we go. So there are different types of stock mutual funds. So first is index funds, which are passively managed. These type of funds are typically constructed to match the performance of a particular index. For example, that portfolio will match the performance of Nifty 50. So an index fund, mutual fund, will match the performance of Nifty 50. Uh, then there is actively managed funds. Funds are those funds where the investor invests and keeps a benchmark, invests in different assets and keeps a benchmark, and he tends to give you more return than that of the benchmark. This leads to greater tax liabilities compared to passively managed index funds. So now there are other forms of pooled investments. First is exchange traded funds. ETFs are technically quite similar to mutual funds, you can say, but these, yes, mutual funds are also uh, on the platforms, on various platforms. You have to buy it from the stock exchange itself. But exchange traded funds are the funds which include different kinds of assets, but these funds are traded on the market. So, next is separately managed accounts. It is a portfolio which is owned by a single investor and which are managed to that particular investor's needs, preferences, risk tolerance, etc. So, what does this no shares are issued as single investor owns the entire account means? It means that the individual owns the security directly and not through any mutual fund. Then next is hedge fund. We will learn about hedge fund in, I think, alternative investments more. So just to give you a brief introduction, hedge funds are the pool of investor funds which are often given to qualified investors only. It is the market of hedge fund is not that much regulated as that is of equity market, and hedge funds also charge you performance fees. Next is private equity or venture capital funds. So these are funds which invest in a particular company directly. So what that tactic is to invest when they are short, then grow them, and once they are grown to a certain extent, sell them off through different exit options like IPO, etc., and get the profit through it. That's all from my side. If you guys have any doubt regarding this reading, it is a very simple reading. So if you guys have any doubt, feel free to comment, and please like my videos, please subscribe, and please share them to your CFA buddies too, and help them to study and grow with us. Thank you. Bye bye.